At the end of the day, what we have is we have an affordability problem that's not going to go away anytime soon. So to me, what that means is that we've got this window of being able to buy apartments right now that are in trouble for maybe 2 years.
Hey everybody, welcome to the 0 to 100 podcast. With me are my co-hosts, Mr. Mitchell England and Gabriel Hamill. And I'm really excited about today. I think this is the biggest badass guest we've ever had on the show. Sorry for all the other guests. You'll get there someday. But we have Ken McElroy, who is a seasoned real estate investor, YouTube influencer, podcast host, author, public speaker, founder of the Collective Advisor Mastermind Group. He owns over 16 businesses and is the CEO of MC Companies, which is a nationally recognized multifamily real estate firm with more than $2 billion in real estate assets. And Ken also recognizes the importance of giving back and spearheaded this Sharing the Good Life Foundation. He's passionate about educating others so they too can achieve financial freedom through real estate investing. Ken creates contents for his 500,000 collective YouTube and podcast subscribers. He also speaks, makes personal appearances, and is the author of several books. Ken's commitment to and his passion for empowering others have made him a sought-after speaker, mentor, and friend to people around the world. So, Ken, thank you so much for joining us. Welcome to the show. Like I said, we're really excited to have you. And Ken's also a short guy too, like the rest of us. So
that's right.
Yes, I am. Yeah.
We have a height limit on our podcast, Ken.
I'm tired of all these tall guys for getting on the podcast. So
finally.
You're in good company, Ken.
Yeah, that's good.
So, Ken, I know your origin story. You started in property management, Seattle area, but it's always interesting to know, like, how do people get into real estate investing, right? Like, I know you're managing properties, but eventually you bought your own and you obviously scaled to 20,000 units. Does that sound accurate?
Yeah, we're 10 now, but we purchased somewhere close to that. And yeah,
that's it. 10.
I know.
Never mind. We got to hop off.
I think there's a lot of paths. First of all, for me, I was looking for free rent while I was in college. I wrestled in college. That's how I got to college, and I really enjoyed it. My dad was a contractor, and I knew how to fix stuff, and I felt like property management for me was not that difficult. You know, you get good people in, you collect rent. I'm simplifying it, of course, but I really enjoyed it. And that for me, that was my path. But what it really did more than anything was it gave me an understanding of why I should buy something, like more than anything. Because I was looking at it operationally. And I think that's a big piece that a lot of investors miss is they have a circle of influence and they raise money or something, but oftentimes they don't really know, like, how do I really fix this, or even maybe what the opportunity is. And by the way, you don't have to start in property management for that. You just really have to find somebody that could help you with that. Like, say, here's the rents are under market, the expenses are high, we can reposition this through a value add or whatever it is. So, but that's the way I came up. And so I felt like I had a huge competitive advantage because a lot of people that are in this business are in it for kind of a transactional nature. And there's nothing wrong with that, but that could be like a realtor or a broker, let's say. A lot of times they have a listing, but they don't really know what they have, right? Like they're just looking for that commission, or maybe we're trying to raise capital and do that quickly and turn it like a flip. Where I've always had a real long-term approach. And I think that has given me a huge advantage. It's harder because not everyone likes that kind of that quick money, but I've always had a 10-year hold philosophy on everything that I like to purchase.
Ken, I got a question. Take us back to, you're working in the property management company. What was your first property and what did that look like? I'm making you go back in time here, but like, what does that look like? Were you scared? There's people listening to our podcast who are brand new. And I love taking somebody like you who's got 10,000 units and going all the way back to that first purchase. What did it feel like? Why did you jump in? What was it?
Yeah, it's a great question. Well, it was a $116,000 unit. This is going back, guys, but it was a 2-bedroom in Scottsdale. And that was one of them. I was buying single families just like a lot of people. And I was using my own money and I was using money that I had saved. That's the way I learned. My parents, my dad, my mom, they're like, save. Even though later I learned that might not be the best strategy and you don't always need money to buy. But back then, that's what I believed. and I used all that money and I bought something that barely cash flowed, like a 50 to 100 grand a month, 150 to $100 a month.
Wow.
50 or $100 a month. Yeah. And that was it. And now I finally was like, okay. And then I got a second one and I ran out of money like everyone. And then I had to learn how to raise money. And then from there, it was 4 plexes, 8 plexes, then bigger units. And then eventually I started buying. My first big project was 182 units. And so I made a big jump after I kind of learned a lot I would say hitting singles.
Ken, how important do you think that first deal is? Because I hear these common stories. Like my first deal, it was, maybe $200 of cash flow a month. But I always think like that action piece, like in a lot of our guests, it's the same thing. They do that first deal. It's not life-changing money, but because they took action, it set them kind of on this path to then do the next one and the next one. Like how important do you say that first deal for you from like a mindset standpoint, and just the fact that you went out there and did something, you took action on your dreams?
It's really an excellent point. I think it's the most important thing because I'll give you a funny story. You guys know I wrote a book, The ABCs of Real Estate Investing, like 20 years ago, right? So I still don't know why I remember this story, but I was doing a book signing way back. And there was a line and this person was like, well, I don't know if I'm going to buy a book. And at the time it was like $20 or something. And, they're just kind of sitting there like, should I buy it? Should I not buy it? And I'm like, listen, if you're not going to buy a book, you're not buying real estate. And I think the point is the same. If there's a lot of people, and I have no issue with thinking things through, but there's a lot of people that go listen to podcasts and read books and go to seminars and stuff and never take action. And I think that they're afraid, obviously, is the core thing. But I think buying the first one is really, really, really important. And so my sister is a great example. She was a bookkeeper at the Everett Clinic, which I grew up in Everett, Washington, for years. And she was an accountant, bookkeeper salary, not a CPA or anything, just didn't go to college. And she was able to buy several houses, over a 10-year period. And fast forward, when her and her husband retired, they were worth a lot, right? So the tenants paid them off. And so I don't think you have to have this crazy plan of scaling fast and building these big businesses or anything like that. I think you could easily buy one every few years, buy one every year, buy one every 5 years, and play the long game here and let the tenants pay them off. And I think that's perfectly acceptable. People don't have to be in a real estate business as a professional to do this.
I got a question for you. So we always talk about, learn, right? Be responsible, like understand what the heck what you're doing, especially when you get into the world of raising capital. We always talk about treat other people's money more importantly than yours. Like Gabe said, take action. We're big mindset guys. And I'll be honest with you, I never thought mindset was important until there's a guy, I'll introduce him to you later. His name is Robert Kiyosaki. I read a book of his many years ago about mindset. And that really, that changed my life. And for me, it was the mindset. I think a lot of people can learn, you can take action, but I think having the right mindset, sort of like, why not me? How do I think differently? How can I be a contrarian thinker? And I've always loved that about you. I feel like you've always been a bit of a contrarian thinker, which I think is important. What would you say is the biggest hack to improving your mindset? Because I do believe mindsets can change. We can come from a background, we can have certain mentors or teachers that teach us how to think. Society can teach us to think a certain way. For people that are listening, that are like, I know I need to change my mindset. I'm still scared to take action. I can't think differently. I've got 20 years, 30 years, 40 years of sort of programming in my brain that I have to undo. What would your advice some of our listeners that know they need to change it, but they don't really know how?
Yeah, it's a great question. I think hands down, the easiest thing, because you got to get out of your own way. And a lot of people don't know how to do that. So what do? I have a phrase I tell people, it's environment is stronger than will. And I believe that environment is stronger than will. We can coach them. We can do this. We can do that. But the minute you change your environment, doesn't mean you have to get rid of your friends. But when you are around people that are doing things, business, real estate, it doesn't really matter what it is. You do glean off of them, right? And so, for me, I got into a group years ago called EO, Entrepreneurs Organization. Now I'm in YPO. When I go into those events, I'm like sitting there just listening and asking questions because everyone in the room is crushing it. So that's why every time I leave an event like that, or I'm in a small group of people that are inspiring, I always have new ideas, and it always kind of gives me that extra little bit, and also validates, okay, well, maybe my bar is a little low. And I think for a lot of people, wherever our bar is set, there's so many reasons. From the time you were young, it is what it is. And then getting out of your own way and punching through that ceiling, whatever your ceiling is. And then, of course, making sure that you're surrounded by people that are already there. And there's so many people already there. And that's the way I've been able to do it, is even now, every time I personally punch through wherever I am, I get around. Like I just was playing golf last week with a buddy of mine that's in the exact same space. He bought 40,000 units, went public. You know what I mean? I'm sitting there shaking my head like, okay, like the bar is all, depending on who you're hanging with, the bar is always bigger when somebody has a bigger one. So for me, it's environment.
I love that you say that. I do think that's one of the biggest hacks. It's just getting in the right rooms.
Yeah, Ken, hearing you say that, I have to wonder, like early on, who were some of the big mentors for you? Who were some of the men and women that made lasting impressions and really helped shape the way you think and what you were able to grow to this day?
Well, oddly enough, the early ones came from sports, right? Like I wrestled. I was pretty good in high school. I would say above average in college. And some of the coaches, and not just wrestling coaches, but we had one particular coach that was a football coach that had a book that he had. It was actually all about mindset. And that was like my first, like, oh, wow. And then all of a sudden from there it turned into more and more stuff, but it started through sports. Then once I got out of college, it started with people that were running businesses. So the first person that owned the first business that I worked for, just trying to be in the same room as them and just trying to listen and keep my mouth shut and ask a lot of questions. And then I went out and sought them. So even when I started having a family, how do you be a great father? You go find people that have kids that love to be around their father. Same thing. So I just been doing that my whole life. I've just been trying to find people that they're doing, what you want, right? And there's a ton of them out there.
Yeah. So Ken, I'm curious, and I'm pivoting a little bit, but I'm curious, like we've got this interesting real estate market we're in the middle of right now. We've experienced super high inflation. The costs of everything have gone up. I'm not in the apartment space. And I know this question I want to ask it right because there's multiple markets, right? It's not just one market. But maybe talk about the multifamily space. I know you have a pulse on that. What's your strategy today? Where do you see things going? Maybe just give us a download on that. And of course, there's going to be questions to follow.
Let's just take a look at the landscape that's affecting everyone. Like you mentioned inflation as an example, which I think is a great segue. What does that mean? That means that things that we own are going to go up or are going up. That means that our people that don't own today, they have that exact same problem. That means that wages aren't following high prices and, so all that stuff. So when you start to look at what the inflation means or what higher interest rates mean or higher costs, all that kind of stuff, you start to see kind of this pattern. And so for me, what it means is that affordability as we see it today is only going to get worse. So the consumer, the renter, Mike, I got 2 kids in their 20s. I actually was having a dinner with him last night, actually. He's 28. He goes, I only know 2 of my friends that own homes. Okay. So when you start to see that kind of stuff, you start to see patterns, right? And so, all right. So what does all that mean? To me, it means that we're heading into this time where there's going to be a tremendous amount of renters. And, we can go down all these rabbit holes and try to solve all that stuff and say, why? But at the end of the day, what we have is we have an affordability problem that's not going to go away anytime soon. We're already undersupplied. We know that. We know that there's somewhere between, depending on who, like there's 3 to 5 million housing units short. We know single family homes are expensive and interest rates are high. So to me, what that means is that we've got this window of being able to buy apartments right now that are in trouble. for maybe 2 years. And they're in trouble for all kinds of different reasons. And by the way, those don't really care about inflation or the consumer or anything. It's just, it is what it is. They're completely in different universes. So you have people that overpaid, got bridge debt, didn't know what they were buying, didn't underwrite them correctly, didn't have the cash, bringing in new money, whatever. All the stuff that's going on, it's all going on. It's just making its way and has very little to do with the affordability problem. So you have this temporary issue going on right now, what I think is an incredible opportunity for purchasing underperforming multifamily today.
Ken, where do you see that opportunity? I mean, I hear what you're saying and I'm thinking, all right, so some of this commercial debt's going to reset. I mean, that's already starting to happen. Is it that the banks don't want the debt on their books and they're going to be willing to negotiate with great operators and great investors? Or where do you see that opportunity? Is it because of the debt reset or is it something else?
So we've personally bought a little over 500 million already this year. And there's so many answers to that. So you've got debt funds that are worried. You've got lenders that are worried. You got construction lenders that are worried. You got developers that are worried. You got equity, both institutional and private, that are worried. All as a result of, I would call it a multifamily market that actually got adjusted when rates went up. Cap rates are up, interest rates are up, all that stuff. So the answer is everywhere. I got a deal 2 weeks ago, 280 units in Dallas, 35% occupied. The debt on it was 25 million. And the broker said that the lender would take 14. Now that's an $11 million haircut at the lender level. That also means that the equity's gone, right? So now that might sound like a really good deal, but I passed. And so why would I pass? I passed because, well, first of all, you got to know that when the person put the deal together, it was probably worth 40 million. Right? Because at least 15 million of equity with 25 million of debt. Now it's worth 14 million. So all the equity's gone. The lender's going to take a haircut. But the biggest issue is I stepped into a 35% occupied building that had a ton of tenant problems, a lot of deferred maintenance. It had a whole bunch of other issues, some insurance related. And I didn't love the location. And so I fast forward all the way to the end to say, what would this be worth if I stabilized it? And it wasn't worth 25 million at today's numbers. And so I passed.
Was this an A class, B class? Like
it was
look at?
Supposed to be a B, but it was more like a B minus. And so those are the kinds of deals that are coming at us. And so I bought 2 class A buildings where they're having a tough time on occupancy, right? And we're looking at one, we just made an offer on one last week where it's fully built and it's sitting at like 48% occupancy. Okay. So I step into that and I have to now, how long does it operate poorly? Is it 1 year? Is it 2 years? How do I budget that and make sure that I have the cash to cover that? Because what I'm really buying is I'm buying properties below replacement cost, right? So on that particular property, we're trying to buy it brand new at $200,000 a door. Okay. I know that it's $300,000 a door to build it, but I'm not worried about the equity and I'm dealing directly with the bank. I'm actually trying to buy it for the construction note. So those are the kinds of deals that are going on. And if you're in the game, we're getting the emails and, we're starting to see those come up. And I think this is a year that you're going to see a lot more of the second half of this year. So it's actually a great time to have dry powder and to look for underperforming assets.
Ken, I've got a question. So I'm in the mobile home park world where inventory goes down. So we don't deal with sort of like the oversupply, undersupply. So my brain has a hard time wrapping around all the dynamics of like, multifamily housing. But you started out talking about the undersupply. Was it 4 or 5 million units? So why do we have all these vacant apartments? You talked about 35% occupancy, 50% occupancy. Maybe it's a simple question, but I'm just like trying to connect the dots.
So you got to go back 20 years ago. So I went through the '08 crisis. All right. And so what happened in '08? In '08, the banks all pulled back. The lenders all pulled back. There's nothing being built for almost a 10-year period. Okay. So let's call it '08 to 2018. All right. This is really important. Not a lot of supply added for 10 years in the US. So then what happened is the population kept growing, more and more people graduating, getting out of school. Okay. So you have a demand, you still had people and you had very little housing being added up to that point. Okay. It's very important that you look at that big picture, because that's actually what made everyone look so good. Is that once the population absorbed all that stuff, then we started to see that big rent growth, which we saw in 18, 19, 20, and everybody looked like they were so smart. But really, it was an undersupply 10-year period. Then everybody's like, oh, okay, it's time to build. So they started building. And then, of course, the pandemic hit, and then interest rates went up. And so it kind of stopped. And so when I'm looking at an undersupply, I'm looking at a 20-year period of time. And so that's National Association of Realtors, National Association of Home Builders, National Multi-Housing Council. There's all these different kinds of Redfin, Zillow. They're all pretty consistent in the undersupply. Now, where and how many and where do people, that all is a whole nother topic, because it's just nationwide, right? So you definitely have areas that are overbuilt. Definitely areas that are undersupplied. Plus, you have all these people moving around all over the place, right? Because they're just pissed off about mayors or governors or pandemic or work from home or whatever it is, right? Or they're just retiring and moving. So you have all those things, but that number is real, and it's specifically because of the undersupply that was created, back from the great financial crisis. And we're still not back, which is reflective in the single family home price, right? Like we're up in the 400,000 range, which is nuts. Now let's talk about apartments, which I think is a great question. So because I build apartments, we have 6 projects going. I have 2 under construction, 2 in lease up. If you take a look at people broke ground in 2021, 2022, these are 2-year builds, 2 to 3 year builds. Like it takes a year just to even open a clubhouse. And then another 2 years or year, depending on the size, to actually finish it. So the stuff you're seeing today started over 2 years ago at these lower rates. And, then rates went up as they adjusted for those inflation numbers in June of 2022. So what developers are caught on is they didn't anticipate these higher construction interest rates. But also, once you put a shovel in the dirt, you're finishing. Like, you know what I mean? Like you got the loan, you got the equity, you're going to build that thing out. And so all those units are hitting right now. And these started years ago. And then what happens though, it drops off. Like you have no idea, like in about a year to 18 months, there's almost no new construction. So it's pretty easy to see like when somebody broke ground and when it opens and when it gets fully absorbed. And to your point, like I just did a video actually last week. We have in downtown Phoenix, just the area where I live, they're doing 4 months free on a 12-month lease, if you can believe that. That's how many units got added into downtown. But if you go 10 miles, over to Tempe or to Scottsdale, you're not going to see that. You're not going to see concessions like that. You're going to see a little bit of rent growth. In fact, you're going to see higher occupancies. So when you talk about this nation's supply, you really got to get down to the submarkets and see like kind of where it's affected most. And then how long will it take to correct? Like downtown Phoenix is toast, in my opinion, for many years. But there are other areas where it's perfectly fine to be able to purchase it, if that makes sense.
So I'm just kind of playing this out, and that makes a lot of sense because I own some multifamily actually in Oklahoma City, which there wasn't a lot of building out there. It kind of replicates, I feel like, the Midwest market. So you're going to see an oversupply because everything was easy. Money was cheap. Everybody was a rock star on social media, cashing their checks, renting their Lambos. And then the interest rates went up. Things got really tough. But so that's where this occupancy issue is. You're competing with a guy that's giving units away, but you're going to see all of these surplus units. I get it. It's different per market, but you're going to see this absorption happen, and then you're going to see rent growth again. And my question to you is like, how does that play out though? Because you also have a different situation. You've got, unlike 2008, right? You have inflation. So the cost of living is gone up considerably. You have a lifestyle creep. People like don't want to let go of their lifestyle. You have over $1 trillion in consumer debt. You've got these organizations out there. In fact, I was just watching your video from 2024 as far as Flex and some of these, buy now, pay later things. Like, I feel like the party's going to stop at some point. And at some point, people just can't afford it anymore, right? If there's going to be a supply issue as a landlord, I feel good about that, right? But at some point, people just can't pay more rent. So what happens? They take second jobs, third jobs. Do people from A class move to B, B to C? People from C move to manufactured housing communities? Like, how do you see this playing out? And then how does it affect your strategy over the next 10 years? Because you are a long-term thinker. And that's what I love about you is it's not just very transactional and you're very thoughtful about this stuff. So I know me personally would be curious, like, how does this affect your strategy as you're building and buying multifamily?
Well, it's interesting. It's another really good, insightful question. I think, like, what's the next stop from a renter below that?
Like Portland, Oregon, like under a bridge.
It's homeless, right? No, I mean, as crazy as that sounds, it really is the street, right?
Yeah,
so
unfortunately,
it's interesting because I've seen this happen in markets. And so renters are really resourceful. In 08, 9, 10, 11, we saw a big fallout, great financial crisis. Remember, we had massively unemployed, lots of units on the market, all that kind of stuff. So we've been through it. My experience has been that they do things like they double up, they move down, they start to get rid of other things. They start to get rid of luxuries like a Netflix or a gym membership. And, they start to pare down those kinds of things. But the last thing that they do is they don't not pay their rent. It's really interesting what happens that, you think about it. It's almost more important than transportation, the roof over their head. So I've seen it. By the way, I do not want that to happen to anybody. It's a horrible time, but the government could step in. There's all this talk around UBI, universal basic income. Again, that's not a bad thing if you own, right? Like, people might be bitching about it, but if the government's going to give your tenants money to pay rent, that's a win. These programs that are going to come out, I think that we might see to help people, I would imagine you might see some of those as people get more and more strapped. You're 100% right. And it's a great thing to think about. But our strategy, I think what's going to happen is we are going to move to this renter nation, where there's going to be more and more people that are focused because they have to be on renting. And then they'll make their own decisions. They'll upgrade if they can. They'll downgrade if they have to. They'll drive an extra however long if they have to be a little more affordable. So for us, we're just trying to, buy below replacement costs, make sure it cash flows, and wait for that absorption to make its way through, which means that a lot of those excess units will be rented over time. And the reason is I don't see any real relief on the single family side of the equation. So a lot of people group real estate into one big category, but as you guys know, single family and multifamily could not be any more opposite. In fact, a single family home builder is trying to take our tenant, and everybody talks about renter by choice and all that kind of stuff. That's a bunch of BS. Mostly, if somebody can buy a house, they're going to buy a house. And there are some, I would argue, that do that for a lifestyle and flexibility of time, but mostly people buy a house if they can and they rent if they can't. And so I think that's only going to get worse until there's more relief on the single family side. And that's only going to come one of two ways: lower prices or lower interest rates. And I don't see any of those two things happening anytime soon. So we're trying to capitalize in this little window.
That makes perfect sense. Ken, one thing you said was cash flow. And I think the word cash flow gets thrown around a lot. I mean, I've always considered myself a cash flow investor. And it's kind of interesting because, when I got started, we're talking like a little bit of cash flow. I was financially free when I had $1,500 a month of cash flow, but my expenses were low. So, I was poor, but it was all that, cash flow positive. And I think back to, we first met in 2012. It was actually the Real Estate Guys Summit at Sea. And, so it's only 4 years out of 2008. And I found it really interesting because there were so many people, not just the speakers on that trip, but also it was the first time I was really around other investors. And there was a lot of investors that completely got their ass kicked in 2008 because they were speculating. These are small investors, medium investors, big time investors, kind of everybody. And all those that bought for cash flow, even though maybe they built a lot of wealth years later from the appreciation, it seemed like those that were investing for cash flow first did fine through 2008. So I'm just kind of curious, like, what's your relationship with cash flow versus appreciation, kind of their relationship with one another? Like, what lens do you look through when you're looking at, multifamily? Is it cash flow first? Is it value add? What's kind of that relationship there?
So if you're raising money cash flow needs to cover the price of the money, right? So I always put that first, always. And so what happened, we bought some properties in Austin in '05. And then, of course, the great financial crisis hit a couple of years later, and we were struggling at the time. And what saved our bacon was cash flow, right? So the property was still cash flowing. We were still covering our mortgages. We were still paying all our expenses. Yes, we wanted value add the property, but it wasn't in the cards, right? So we had to wait until all that stuff worked its way through. So that property that started off as a value add in the first few years, we had to bump 6, 7, 8 years later. But again, I'm a 10-year holder, so who cares? But what saved my bacon was the cash flow during that period of time. But we did not get the appreciation. We did not get the value add. And I think that's kind of the point. So it should be, if you're at a waterfall it down, it should be cash flow first, value add and appreciation second, and always secondary. And I think what happens is a lot of time people they flip it around. They minimize cash flow as if it's not an issue. But for me, I just never know when the market's going to turn. I mean, we all try to figure that out. But the reality is stuff can come quick. And I've been through a few of them where you're just better off to have that cash flow based strategy at all times.
It's interesting that you said that, because if you can hold on to a piece of property, like even the people that are in trouble now, right? They miscalculated their underwriting. They expected rates to stay in the 3 or 4%, whatever, forever. Rates have gone up considerably. The cost of maintaining and managing these complexes have gone up considerably. But your advice to people that are holding assets that might be tough, but they can hold. Yeah, maybe they're limping along, but you just hold and wait. Because I feel like we talk about this on the show all the time, like having real estate gives you a lot more options than not having real estate. Like you mentioned, I think it was your sister or your sister-in-law that just like you buy a few properties every couple of years, things eventually work themselves out. Would your advice to be to these people, just hang tight, just like see this thing through the next 12, 24, 36 months, and you should be at a different situation?
If they can. Yeah, absolutely. And so that's why everything we're buying even today, cash flows, everything, every single thing has cash flow today. So what we're trying to do is just make it through, right? Because we don't know like where occupancy is heading, where interest rates are heading, where these expenses are heading. We don't know what's going to go on with the tariffs or, all these crazy like rent freeze and, all these different things that can happen with a mayor or governor or whatever it is. You just don't know. So you have to have cash flow and you have to have cash reserve. That's the prudent way to buy anything. Even a business, you should be running it that way. You should always be thinking, okay, if I lose this big client, how am I going to make it through? But the weird thing is that when people were buying real estate, they just threw all that out the window. They're like, okay, we're buying it here. We're going to sell it here in a couple of years. That's just not how it works. Hopefully it does. But in a market like this, you look like a superstar. But in the ones that cracked, the ones that didn't prepare, they're the ones that ran out of money, the ones that didn't buy rate caps, the ones that have floating rate debt, or the ones that don't know how to manage, don't even know what to do when they walk onto a property. They don't even know what to ask. All they could do is raise money on TikTok. You know what I mean? Those are the ones that are in trouble.
Ken, do you think that's just because people in general, like they're attracted to that fast money? And I mean, I think about like, I bought my first property in '05, but I really got serious in '09. And I had all these people. And now I'm reading your books and Robert Kiyosaki's books. So like, I'm like cash flow, cash flow, cash flow. So 2009, 10, 11, 12, 13, I'm like buying all these no money down seller finance deals. And people are telling me, oh, values are going to go down. What if? And I'm like, my cash flow is the same. In fact, there's more renters. Like my cash flow is actually going up every year. I don't care the value on paper. Like I literally didn't care. Now, fast forward 20 years later, there's a shit ton of appreciation. But why is it that so many investors, do you think, are attracted? Is it just because it's easy money, like buy low, sell high, and they don't understand the difference between making money and building wealth? I just feel like I see a lot of young investors that want that fast, easy money, but they don't understand what it means to build long-term wealth.
Yeah, I think that's normal. I got to tell you, like in my 20s, I probably thought the same thing, And I think some of it's wisdom. I very rarely find a 20-year-old investor that thinks long term, but I'll tell you what, it hits you fast, man. When you get into your 40s and 50s, like you start to think a little differently, especially when you have families and all that kind of stuff. And I think that's normal. So yes, I do think that's part of the process. That's part of the reason why you want to get mentors. That's part of the reason why, for me, every time I got to tell you, like, I don't even know right now what my net worth is or how much equity we have on our stuff. I just don't even pay attention to it at all. Now I have to sometimes when we're trying to go get a loan, obviously, and I have to put together my financials every quarter for our banks. So my CFO does it for me, but it's just not on my mind. I'm like, okay, am I cash flowing and are my tenants paying off my debt? And am I doing what I said I was going to do in the business plan? Because if I do all of those things, the value will be there. And not to say I don't look at it from time to time or try to manage to it or anything like that. But the only time it ever makes any sense at all is when you're actually going to sell or refinance. So why obsess on it? And I think a lot of people, they look at a lot of people's net worths are in their equity in their home. So I get it, right? Like most Americans have a lot of equity in their home. And that's a lot of times where their net worth is. So I think that I get that mentality. But for me, I just don't care. I'm playing the long game. I'm buying properties that, I'm trying to capitalize on and maybe refinance in 3, 4, 5, 6 years from now. And maybe if the interest rates are cooperating, but they might not be, so it's a long game.
I hope everyone listening to our show goes back and like re-listens to that 2-3 times. Like that philosophy, like what you just said, really helped shape my early investing. Like I owe a lot of, my early success to that philosophy of like buy for cash flow. And so like for our younger investors or even our more seasoned investors, like go back and listen to what Ken just said on repeat, maybe 3, 4, 5 times until it really, really sinks in, because cash flow is what's allowed me to be in the position I'm in today and be able to pull those levers when I need to. So, personally, I want to just thank you because that's something that's, your philosophy has impacted my real estate investing philosophy quite a bit through the years.
Last question, because I know we're out of time. You mentioned interest rates are going to stay sticky. In your opinion, we don't have a crystal ball, right? You got tariffs, you got the overnight rate, you got treasuries that are all over the place. If you could sum up in just 30 seconds, why do you think rates are going to stay sticky? I mean, the Fed might be getting politicized here soon.
If you look at his first term, he likes low rates, right? He's a real estate guy. So he gets to appoint a new Fed chair next May. So I think you got a year probably of maybe Powell's going to, I think, just put his feet in. Maybe you get a little bit here and there, right? Depending on where inflation and unemployment go. And I think the real wild card that nobody's really talking about is actually AI. I think that they're coming after that first tier white collar, the kids that just got out of college and don't know anything, that think they do, that have degrees. They may or may not even be obsolete at this point based on a lot of stuff. So that first tier, I think that's going to really add to unemployment. And, the Fed has that dual mandate, right? They have inflation and unemployment as kind of the two things. So I think that lower interest rates will for sure create another bubble. And all that's going to do is if I'm cash flowing today at 5, 6, 7%, I'm for sure going to cash flow when rates go down. And I already did this in 08, 9, 10, 11, 12 when we were buying, rates started to go down again. And we were just harvesting that money through cash out refis. And our payment was staying the same. And we were just scooping the cash tax free during that period. And so that would be the optimal for me, but I don't always know where this is headed. But if it cash flows today, it'll cash flow tomorrow. I'll hedge the up and I'll take advantage of the down. But I do think Powell's going to hold the line for a while, maybe a little bit here and there. But I think it could be a very different scenario once that new Fed chair comes in, which will be next summer.
Yeah, that makes perfect sense. Ken, we have one final question that we ask all our guests, and I don't want to let you leave here without asking you as well. Hypothetical, if you were to lose it all tomorrow, you do not have any real estate, you don't have any net worth, you don't have any of your relationships. So your net worth, your real estate, and your network is gone, but you do have all your knowledge. So you're sitting on the curb tomorrow by yourself. The first thing you do.
Pretty
I can just
hopeless,
picture
Gabe.
Ken sitting on a curb by himself.
Yeah.
We got to ask you the question, man. Everybody gets it. So,
Well, I think it's a great question. I would always just do the exact same thing. I'd go find something really distressed in a great area, and then I would go find the money because you did mention I still had the experience. So this is exactly how you do deals. Like everybody shies away from broken, vacant, bank owned. To me, that's like, okay. And so what do those deals need? They need somebody to fix them. So if I would put together the teams and I would immediately get that deal done, I always tell people the bigger the brochure, the worse the deal. If you can find something like find a vacant building and before you close it, find a tenant, like literally anyone can do that. Seriously. I've been doing these billboards lately. So I've been buying billboards that aren't cash flowing. I replace them with digital faces and immediately I have 16 ads, 8 per side versus 2. And so it's like real estate is always what you see. So that's the competitive advantage I would have is I would see things and then I would have to find all those new people to help put it together.
Yeah, love it. Ken, thank you so much for being on. This has been an awesome episode.
Anytime, guys. Hey, good luck to you guys. That's great being on your show. Thank you.